While public attention was locked on the inauguration ceremonies and the spectacle of political theater, inside the marble corridors of the Treasury Department, a mechanism was activated that will redefine the purchasing power of every dollar-denominated account in the United States. On January 19, 2025, the Treasury General Account held $54 billion. The statutory debt ceiling stood at $31.4 trillion. The gap between authorized borrowing and actual obligations had collapsed to zero. Again, this is the fifth debt ceiling crisis in 12 years, but the architecture of this iteration contains a structural anomaly that previous cycles did not. The Federal Reserve's balance sheet has expanded by $4.2 trillion since March 2020, while the reverse repo facility drained $2.1 trillion in liquidity from money markets between April 2023 and December 2024. The system is now operating with negative slack. What you are about to hear is not a political narrative. It is a technical dissection of a controlled demolition disguised as a legislative negotiation. This is the debt ceiling illusion, and the math no longer supports the illusion. The official narrative is familiar. Congress must raise the debt ceiling to allow the Treasury to continue borrowing. Without an increase, the United States risks default on its obligations. Social Security payments, military salaries, bond interest, all theoretically at risk. The Treasury Secretary announces extraordinary measures. The Civil Service Retirement and Disability Fund is suspended. The Government Securities Investment Fund is frozen. These are accounting maneuvers designed to buy time, typically 90 to 120 days. Markets react with measured concern. The VIX spikes modestly. Treasury yields invert slightly. Credit default swaps on U.S. sovereign debt tick upward from 0.35 basis points to 0.62 basis points, a rounding error in the grand ledger of global finance. Analysts on financial networks reassure viewers that this is theater. Congress has raised the debt ceiling 78 times since 1960. Default is unthinkable. The full faith and credit of the United States government is sacrosanct. Both parties posture. Democrats demand a clean increase. Republicans demand spending cuts. The deadline approaches. Negotiations intensify. At the final hour, a compromise is reached. The ceiling is raised. The crisis is averted. This is the story you are told. It is not incorrect. It is incomplete, because the debt ceiling is not a constraint. It is a release valve, and the pressure behind that valve is no longer manageable through conventional legislative theater. To understand the structural fragility, you must first understand the plumbing. The United States Treasury does not hold cash in the traditional sense. It holds balances at the Federal Reserve in an account called the Treasury General Account, or TGA. When the government spends, the TGA balance decreases. When the government collects taxes or issues debt, the TGA balance increases. During the pandemic response, the TGA balance surged to $1.8 trillion in July 2020. This was unprecedented. The Treasury had front-loaded borrowing in anticipation of massive fiscal outlays. But this created a secondary problem. When the Treasury spends from the TGA, reserves flow into the banking system. When the Treasury borrows, reserves are drained. The Federal Reserve simultaneously was conducting quantitative easing at a scale never before attempted. Between March 2020 and April 2022, the Fed purchased $4.6 trillion in Treasury securities and mortgage-backed securities. This flooded the system with reserves. But reserves are not neutral. Banks are required to hold reserves against deposits. When reserves exceed the banking system's capacity to deploy them as loans, they become a liability. Banks began parking excess reserves at the Federal Reserve's reverse repo facility, which offers a risk-free overnight rate. By mid-2023, the reverse repo facility held $2.5 trillion. This was a pressure valve for excess liquidity, but it was also a timer. Because as the Treasury rebuilt the TGA after each debt ceiling resolution, it drained reserves from the system. And as the Fed began quantitative tightening in 2022, it stopped adding reserves. Now observe the convergence. As of January 2025, the reverse repo facility has declined to $312 billion. The TGA sits at $54 billion. The Fed's balance sheet has contracted by $1.7 trillion from its peak. The system is running on fumes. Here's the mechanism. When the debt ceiling is raised, the Treasury will immediately issue between $800 billion and $1.2 trillion in new debt to replenish the TGA. This issuance will drain reserves from the banking system at a velocity not seen since the 2008 financial crisis. But the reverse repo facility no longer has sufficient capacity to absorb the shock. The liquidity buffer has been exhausted. This creates a cascade risk. As reserves are drained, banks face a choice: reduce lending, sell assets, or borrow from the Fed's discount window. Each option introduces friction. Reduce lending tightens credit conditions. Asset sales depress prices. Discount window borrowing signals distress. The Federal Reserve is aware of this. In December 2024, the Fed announced a technical adjustment to the standing repo facility, expanding eligibility and reducing the stigma of usage. This was not a routine policy tweak. It was preparation for a liquidity event. The debt ceiling is not a constraint on borrowing. It is a mechanism for periodically draining liquidity from the financial system under the cover of political theater. And the actors who benefit from this mechanism are not elected officials. The United States Treasury does not sell bonds directly to the public in meaningful volume. It sells bonds to a network of 24 primary dealers, financial institutions authorized to bid at Treasury auctions. These dealers then distribute the bonds to institutional investors, foreign central banks, and retail buyers. The largest primary dealers are subsidiaries of the largest asset managers and banks in the world: JP Morgan Securities, Goldman Sachs, Bank of America Securities, Barclays, and the broker-dealer arms of BlackRock and Vanguard's custodian networks. These institutions do not simply facilitate auctions, they shape the terms. When the Treasury announces an issuance calendar, primary dealers provide feedback on demand conditions, maturity preferences, and yield expectations. This is called market color. It is also called price discovery. It is also called negotiation. When the debt ceiling is raised and the Treasury floods the market with $1 trillion in new issuance, primary dealers are the gatekeepers. They determine how much they will bid, at what yield, and under what conditions. If demand is weak, yields rise. If yields rise, the cost of servicing the debt increases. If the cost increases, the fiscal position deteriorates. But there is a second layer. The Federal Reserve, through its System Open Market account, holds $4.9 trillion in Treasury securities as of January 2025. When these securities mature, the Fed has a choice: reinvest the proceeds by purchasing new treasuries, or allow the balance sheet to contract by letting the securities roll off. Since June 2022, the Fed has been allowing up to $60 billion per month in treasuries to roll off. This is quantitative tightening. But the Fed retains discretion. If market conditions deteriorate, the Fed can pause the runoff or resume purchases, and this creates a coordination problem. The Treasury needs to issue $1 trillion in new debt. The Fed is withdrawing $60 billion per month in demand. Primary dealers must absorb the difference, but primary dealers are not obligated to absorb unlimited supply at favorable yields. The result is a negotiation conducted through market signals rather than explicit communication. If the Treasury issues too much too quickly, yields spike. If yields spike, the Fed faces pressure to pause quantitative tightening or restart quantitative easing. If the Fed restarts easing, inflation expectations rise. If inflation expectations rise, long-term yields rise further. This is not a conspiracy. It is a coordination game with asymmetric information and misaligned incentives. The Treasury seeks to minimize borrowing costs. The Fed seeks to maintain financial stability and control inflation. Primary dealers seek to maximize profit and minimize risk. The debt ceiling creates a forcing function. It compresses the negotiation into a narrow time window, amplifying volatility and extracting concessions from the party with the weakest position. In this cycle, that party is the Treasury. And the concession is not a higher interest rate, it is a structural shift in the composition of debt issuance toward shorter maturities, which increases rollover risk and embeds fragility into the system. The closest historical parallel is the 2011 debt ceiling crisis. In that episode, Congress delayed raising the ceiling until August 2, 2011, 2 days before the Treasury's projected default date. Standard & Poor's downgraded U.S. sovereign debt from AAA to AA+ for the first time in history. Equity markets dropped 17% in 2 weeks. Treasury yields, paradoxically, fell as investors fled to safety. The resolution came through the Budget Control Act, which imposed spending caps and created the sequestration mechanism. The debt ceiling was raised, the TGA was replenished, markets stabilized, but the systemic conditions in 2011 were fundamentally different. The Federal Reserve's balance sheet stood at $2.8 trillion, less than one-third of its current size. The reverse repo facility did not yet exist as a major liquidity tool. Bank reserves were ample, but not excessive. The Treasury issued debt into a market with structural demand from foreign central banks, particularly China and Japan, which were accumulating dollar reserves. In 2025, those conditions have inverted. The Fed's balance sheet is $7.2 trillion. The reverse repo facility has been drained to $312 billion. Bank reserves are declining. Foreign central banks are net sellers of treasuries, and China's holdings have fallen from $1.3 trillion in 2013 to $816 billion in December 2024. Japan's holdings have plateaued at $1.1 trillion but are no longer growing. The demand structure has shifted. In 2011, 47% of Treasury debt was held by foreign investors. In 2025, that figure is 29%. Domestic institutions, banks, pension funds, mutual funds now hold the majority, but domestic institutions are price sensitive. They will not absorb unlimited supply at suppressed yields. This creates a new failure mode. In 2011, the risk was political default, a failure to raise the ceiling. In 2025, the risk is market default, a failure to find buyers at sustainable yields. The Treasury has already signaled this shift. In the December 2024 refunding announcement, the Treasury increased the proportion of bill issuance relative to coupon securities. Bills are short-term debt, maturing in 1 year or less. Coupons are long-term debt, maturing in 2 to 30 years. Issuing bills reduces immediate borrowing costs because short-term yields are lower than long-term yields, but it increases rollover risk. A greater proportion of the debt must be refinanced more frequently. If market conditions deteriorate, the Treasury faces a refinancing crisis. This is the 2025 divergence. The debt ceiling will be raised, the TGA will be replenished. But the underlying fragility will deepen. The system is not being repaired, it is being compressed. This is not financial advice. This is analytical positioning based on observable systemic stress vectors. First vector, duration risk. When the Treasury issues $1 trillion in new debt, long-term yields will face upward pressure. Bonds with longer maturities will experience price declines. If you hold long-duration fixed income, the mark-to-market loss will materialize within 60 to 90 days of the debt ceiling resolution. Analytical position. Reduce exposure to bonds with maturities beyond 10 years. Shift toward floating rate instruments or Treasury inflation-protected securities, which adjust for inflation and reduce real yield risk. Second vector, credit availability. As reserves are drained from the banking system, lending standards will tighten. Small and mid-sized banks, which rely more heavily on reserve balances, will reduce credit lines and increase interest rates on variable rate loans. If you carry variable rate debt, home equity lines, business credit lines, the cost will increase. Analytical position. Refinance variable rate debt into fixed rate instruments before the debt ceiling is raised. Lock in current rates while liquidity conditions remain stable. Third vector, equity volatility. The liquidity drain will compress risk asset valuations. Equities, particularly in sectors with high leverage or low cash flow, will face selling pressure. The VIX will spike. Correlations will converge. Diversification will fail. Analytical position. Increase cash allocations, not as a permanent position, but as dry powder for deployment during the volatility window. Historical patterns suggest a 10 to 15% drawdown in equity indices within 90 days of large-scale Treasury issuance under tight liquidity conditions. Fourth vector, dollar strength. As the Treasury drains global liquidity through debt issuance, dollar-denominated assets become scarce. The dollar index will strengthen, emerging market currencies will weaken, commodity prices, which are inversely correlated with dollar strength, will face downward pressure. Analytical position. If you hold non-dollar assets or operate in non-dollar markets, Hedge currency exposure. If you are dollar-based, recognize that purchasing power relative to foreign goods will temporarily increase, but domestic inflation will persist due to structural supply constraints. These are not predictions, these are mechanical outcomes of observable liquidity dynamics. The system is not random, it is deterministic within defined parameters. The parameters are now visible. The Federal Reserve is not passive. It has deployed three mechanisms to absorb the liquidity shock. Mechanism 1, the Standing Repo Facility, announced in July 2021, operationalized in 2022, expanded in December 2024. This facility allows banks and primary dealers to borrow cash overnight against Treasury and agency securities collateral. The rate is set at 5 basis points above the top of the federal funds target range. The expansion in December removed certain eligibility restrictions and increased the per counterparty limit from $500 billion to $750 billion. This is a liquidity backstop. It signals that the Fed anticipates stress. Mechanism 2, the Bank Term Funding Program. Introduced in March 2023 after the collapse of Silicon Valley Bank, this facility allows banks to borrow against securities at par value rather than market value. It was scheduled to expire in March 2024, but was extended through December 2024, then quietly rolled into a permanent facility under a different name in January 2025. This is a solvency backstop. It prevents banks from realizing losses on underwater bond portfolios, but it also creates moral hazard. Banks can hold duration risk without consequence, knowing the Fed will provide liquidity at par. Mechanism 3, foreign repo pool operations. The Fed operates a repo facility for foreign central banks, allowing them to temporarily exchange Treasury securities for cash. Usage of this facility spiked in March 2023 and again in October 2024. This indicates that foreign holders are facing dollar funding stress. The Fed is providing dollars to foreign central banks so they do not dump treasuries into the open market. This is a demand backstop, but it is also a subsidy. The Fed is absorbing the liquidity risk that foreign central banks are unwilling to bear. These mechanisms are effective in preventing acute crises, but they do not resolve the underlying imbalance. They shift risk from the private sector to the Federal Reserve's balance sheet, and the Federal Reserve's balance sheet is not infinite. The Fed's capital position has deteriorated. As of December 2024, the Fed reported negative equity of $183 billion. This is an accounting artifact. The Fed cannot technically become insolvent because it creates the currency, but it is also a signal. The Fed is operating with negative net interest income. It is paying more on reserves and reverse repos than it earns on its asset portfolio. This constrains the Fed's operational flexibility. Politically, it becomes difficult to justify further balance sheet expansion when the central bank is reporting losses. Technically, it reduces the Fed's ability to absorb additional risk without congressional recapitalization. The system is fighting back, but the countermeasures are embedding new fragilities. The architecture is becoming more complex, more opaque, and more dependent on continuous intervention. 4 structural truths. 1. The debt ceiling is not a borrowing limit, it is a liquidity extraction mechanism disguised as a legislative constraint. 2. The Federal Reserve's balance sheet has become the lender of last resort, not for banks, but for the Treasury itself. 3. The shift toward short-term debt issuance is not a cost-saving measure. It is a symptom of demand exhaustion in long-term markets. 4. The system is not collapsing. It is being deliberately compressed to extract maximum value from existing claims before the next reconfiguration. The debt ceiling will be raised. It always is. But the terms of the raise will determine the trajectory of the next 6 months. If the Treasury issues $1 trillion in 90 days, expect a liquidity event in Q2 2025. Equity volatility will spike. Credit spreads will widen. The Fed will pause quantitative tightening. If the Treasury staggers issuance over 180 days, the pressure disperses. Markets stabilize. The crisis is deferred. But the math does not change. The United States government will add $2 trillion in debt in fiscal year 2025. Interest expense will exceed $1 trillion for the first time in history. The debt-to-GDP ratio will cross 130%. This is not sustainable, but sustainability is not the objective. The objective is control. Control over the timing of the adjustment, control over who bears the cost, control over the narrative. The debt ceiling illusion is not that default is impossible. The illusion is that the system is still operating under the rules you were taught, the demolition is controlled, but the rubble is real.